I'm curious just how much you think this downgrade has to do with the severity of the drop that we saw yesterday, or was it just a reason for people to hit the sell button because it's been such a great run so far in 2023?
Hi, good morning. Thanks for having me. I think it is the latter reason. I think the rally we have seen this year is pretty significant, and especially driven by the tech sector. And we saw the valuations actually are very high, and the re-rating has actually gone a bit too far compared to the level of real bond yields, for example. So I think it's just one of the reasons for investors to actually take some profits off the table, particularly after we've got some more strong labor market data from the ADP employment yesterday, which suggests the Fed may have to keep rates high for longer.
Higher for longer seems to be the overall theme and what we are prepared for. Joanna, though, if you look at the way that the fixed income markets have reacted so far, it's been interesting. If we are thinking that there's a downdraft ahead, and the conventional wisdom is that U.S. Treasury bonds and that market is the place people go for safety, where is the disconnect, and why are rates heading as high as they are if the prospects for maybe the economy and safety overall are in question?
Well, I think what we were seeing even just yesterday and in other parts of the year is like, this seems like a very familiar story. The markets are reacting to an event. We've had so many different events in 2023, from bank failures to debt crisis to this downgrade. But what we've seen and what has been true is the resiliency of the U.S. economy, the structural change in fixed income, putting rates at historical highs. We are nearing the end of the Fed rate hiking cycle, which I think is very clear. And actually, we take a little bit of different view. We don't see at Bond Blocks a recession happening in 2023. I think that is consensus across many other banks and other views in the market. And what I feel is more important for people to start focusing on is we are starting to see a shift in flows that are moving away from the short side, the cash, where people have been parking cash for a long time, and towards more duration, and also considering credit and other risk assets. And I think what we're hearing from clients is they're ready to get back in. Yesterday was a reaction to a market event and to the downgrade, but we've seen these days, day over day, week over week, change quite quickly. We really have to focus on the structural differences of 2023, which is, economic resiliency, corporate fundamental strength, and also, a structural change in rates.
Joanna, you mentioned the flows and where you're seeing some of the more of the action. I'd like to follow up on that, Joanna, if I could. If you look at the rates picture right now, it sets a certain scene. Are you seeing any developments within, say, investment grade corporates, high yield, municipals? Where exactly is the action right now? Where are people moving rather than just saying, hey, it's just straight duration on the U.S. Treasury side of things? Are there pockets of opportunity elsewhere in fixed income outside of Treasuries?
Yes. So we are seeing people move out on the curve in Treasuries, maybe just into the belly of the curve, sort of sets people up for 2024, the 2, 3, 5 year. There's a very intuitive trade to that, where, people anticipate rates going down sometime in 2024. But the other thing that I think is really compelling is everybody got, 2023's markets wrong. Whether you were on the equity side or the fixed income side, the returns were excellent. It was just very hard to put that money into the markets earlier in the year. And so where I think clients are considering credit, even in high yield, is that if you want to step back into risk assets, you're looking at, on the high yield side, broad high yield, you're looking at returns of upwards of 8% this year. And if you cut that up into ratings qualities, the CCC sector, the CCC side of high yield has outperformed all categories by 11%. And so as people are starting to gauge whether they think that the economy is going to take a turn,
sure,
and they want to get back into risk assets, they might choose fixed income first because it's higher up in the capital structure,
right?
And you really can't ignore those yields that are locked in for you.
All right. So Janet, I'm going to give the last word to you here. Over the course of the last year, maybe even more, we've spent a lot of time talking about this anticipated recession, one that now doesn't look like it's going to come to fruition, at least at face value. Is there still a threat right now that we could see an economic downturn in the next, say, 6 to 12 months, because it just catches people off guard?
I do think so. I think you can certainly build a case that we are likely to see a soft landing given the economic resiliency, particularly in the labor market. But we know that the labor market data is lagging, and there are a number of indicators that still suggest recession risk. For example, tightening lending standard and contraction in manufacturing PMI, and that's global, by the way, pretty broad-based weakness. And also, of course, the inversion of the yield curve, which is actually pretty intense. So I think we can't ignore these signals that the market is telling us. So I think we are still relatively cautious in terms of views on risk assets. We think there will be plenty of headwinds, particularly, as I mentioned, monetary policy is likely to remain tight. And historically speaking, if these conditions remain tight for longer, that is likely to be accidents waiting to happen.